I'm Foreman, and in this video I'm going to give a stock analysis on Games Workshop stock by giving my views on the business, whether I personally would buy shares of GAW right now. And if you find the video useful, please drop one of these, support the channel. Before we start, I should disclaim that I already hold shares in Games Workshop, although I don't want that to take away from the content of the channel, but rather I'm going to try and remain as unbiased as possible, but also show the reasons as to why I personally hold this stock. I hope that it adds more transparency to the content I provide, but also help identify stocks that I might in particular be interested in. Games Workshop designs, manufactures and retails miniature figures under the brand of Warhammer. This means they're able to make sales via trade, retail and also online. And this is completely vertically integrated, meaning they control all levels of the supply chain. This allows them to have more control over their pricing, but I'll talk later on that in the video. But this could also mean that they have higher profit margins from it. They also publish various titles, and this is lesser known in my opinion, including short stories, audio dramas, and also full-length novels under the Black Library brand. GAW is listed in the FTSE 250, has a market capitalisation of £3.4 billion and 2,200 employees. I believe Games Workshop is in an oligopoly market structure, but in terms of the retail miniature figurine market. On the other hand, I also believe that they are in a virtual monopoly when it comes to their board games, as there's very limited competition and they are market leaders by far. They also have a very significant moat, and that's due to their scale and also vertical integration, meaning they're able to control distribution, which could subsequently control prices, but also present a lot more innovation than their competitors. This could lead to pricing control, as I mentioned, which isn't typically a feature of an oligopoly market structure, as typically if you increase the price of your products, you will lose market share. But because their product offering is so unique, this puts them in a virtual monopoly in which it's unlikely that they will lose market share from this. But then, despite the mass production of their supply chain, they could also be under threat from 3D printing in the future, which could certainly undercut their prices and subsequently claw up market share if it becomes more of a threat, or customers believe that it's better value to buy the 3D printed models rather than that provided by Games Workshop themselves. When looking at the financials of Games Workshop, we can see that they are very good. In the last 5 years, they've managed to grow their earnings by a compound annual growth rate of 32.7%. Furthermore, they've had incredible revenue growth in the first half of the financial year in 2020, which finished at the end of November 2020. They had shown that they'd managed to grow their revenue from 148.4 million last year up till December for the 6 months to 186.8 million this year. But this just gets better, and because of that vertical integration that I had mentioned, this means that they're able to maintain much higher profit margins, which are actually as high as 31.7% compared to just the 28.8% last year. Although Games Workshop is a hobby stock, that requires time and a money investment to enjoy. During the pandemics, people certainly had a lot more spare time on their hands when thinking about the lockdowns, and as a nation we were certainly saving more. This could mean that we've seen an inflated level of growth within Games Workshop and their financials, and this is because people were spending less, and therefore with the extra time that they had, they may have put that money into their hobbies, for example, rather than other discretionary spends. On the other hand, hobby stocks seem to be very resilient in recessions, as people will prioritize these over discretionary spends like I've mentioned before, but by no means would this have more of an advantage compared to utilities or rent, as I don't think people would miss their power bills or rent bills at the stake of their hobby. But this does go with the strategy of Games Workshop's management. They try to add shareholder value by distributing truly surplus cash to investors, and they do this by giving value in the form of dividends. But they do not believe in inorganic growth. This means it's unlikely we will see them looking for acquisitions to further build out their brand library, as they believe in organically, slowly and steadily growing their own business model. But this also means it's unlikely that they will do share buybacks, but rather just give it back as a majority in dividends, which could potentially mean that there's a lot less growth potential in this company, whereas if they could have invested that money back into the business, bought more brands, then they probably could be a much bigger company today. However, from this negative, they have actually got a very high quality dividend, which currently yields around 1.77% and is a rare quarterly dividend payer in the UK. GAW does have a payout ratio on the higher end of my personal tolerance, which is 54%. I really don't like stocks that are higher than 60%, but this does allow them to reinvest 46% of their earnings back into the business for that growth. In my opinion, their dividend history looks like a Ninja Warrior course. It's because there's loads of little steps, it's very volatile, and then there's that big wall at the end that you have to climb up. This has meant that in the last few years, they've drastically hiked up their dividend payments. That's because in the last 5 years, they had made a transition and recovered very well by adapting their business model and strategy. This has led to a compound annual growth rate of their dividend in the last 5 years of 35.84%, and in the last 10 years, a CAGR of 15.18%. And this compared to other companies in both the FTSE 100 and FTSE 250, their 5-year compound annual growth rate is completely unmatched, and they are at the top. And if you'd like a free share worth up to £100, sign up to Trading 212 using my link in the description down below and deposit just £1 for that free share. You could also sign up to Freetrade, which you can get a free share up to £200 where you deposit just that £1. Once again, links are in the description down below. In my opinion, one of the better qualities of Games Workshop is their fantastic balance sheet, in which their short-term assets outweigh their short-term liabilities and long-term liabilities combined. But it gets better, as they also have absolutely zero debt on the balance sheet and a strengthening cash position of at least £96 million, which they've mentioned increasing their buffer of cash due to the recent pandemic to therefore prepare for emergencies. But I think there's a lot of cash here that this means they could certainly be growing their dividend by quite a high amount in the next year. Whilst there are some concerns that video games are taking market share from Games Workshop, Games Workshop are well placed to capitalise from the growth in video games, and this is due to their expansive IP, or intellectual property, and they do this by generating more novels and short stories using their Black Library brand. This means that since they are constantly generating and developing their Warhammer universe, it gets bigger and bigger. This means eventually companies will be interested. They would say, hey, I would like to use your intellectual property. I can pay you for this and we can create a product using your brand. Likely video games, in which there is a game called Total War Warhammer. This is by far, in my personal opinion, the best Total War game to date, and there has been 2 of them released, and both have added on each other. They have certainly built an appeal to people that weren't necessarily interested in the figurines themselves, but then have bought the game and thought, you know what, actually I can transition to this. So they're taking advantage not only from video games and their growth, but their brand awareness is becoming larger, more people are aware of it, and then also they could transition into the figurine player base, which just increases their margins further. Furthermore, as royalties, they have little to no expenses, so all revenue from royalties, or a large majority of it, is going to hit their bottom line or earnings, meaning, as I said, more profits. Furthermore, with Total War Warhammer, in the last year there were at least 40,000 people playing at any one time, although I suspect as of late this may have dipped down. You could also argue that Games Workshop has an aging fan base, and whilst in the short to medium term future this is great because as they age they likely are generating a higher income and therefore have more disposable income, but in the long term it's likely that they could therefore age, pass away, and this means that there's no more customers that are regular. But what we could argue against this is that with their royalties and video games, that they can capitalise on the younger player base and get them aware of the brand to then transition to their figurines. But there's also potential for intellectual property to be used in film studios or entertainment, and I believe there is an animated TV series in the makes, but this is personal speculation from me and literally off the top of my head. But this could gather a completely different audience, which once more they could diversify their customer base and have not this aging fan base population, but a well diversified community that is likely going to continue growing as they expand. But they could also have a diverse range of films and characters/stories that could likely rival Marvel in the very long-term future. Although you could argue Games Workshop is a retailer, they have a lot of high street stores and the high street is dying. So how can Games Workshop take advantage of this if they are exposed heavily to the high street? But it's worth noting that they are simply more than just high street stores. They are community hubs. Individuals that embrace themselves in this community, I don't know why I said embrace, that sounds really odd. People that enjoy the hobby will likely go to these Games Workshop stores to meet up with other individuals in the community. This is a great way to build branding. Furthermore, people will likely notice these shops and the people inside them from a distance, furthermore just increasing that subconscious branding available. But then this is even better because they had mounted a one employee policy. This means that they only need one employee to run a shop at any given time, which effectively reduces the overall costs of running a high street store and makes it more worthwhile. This means if they place it in key strategic locations, not only is it fairly cheap for them to maintain, but also they can gain that well-needed brand awareness and convert more customers to their player base. With great growth potential and in my opinion potential to 10 times in the long term, this is no surprise that this is the second largest position in my portfolio. Even if their growth slows down, which I would definitely expect as their growth rate in the last 5 years has been beyond incredible, and this is due to multiple expansion on their price to earnings ratio, leading to them to be far from undervalued as they trade at much more significant premium. But this means that even if their growth slows down, I think in the next 5 years they could certainly see an additional 200 to 400% returns, and a lot of this would be from earnings increases, especially if they're able to continue growing their financials, but also we may see further price to earnings multiple expansions as they're already trading at a price to earnings ratio of 35 times. They could certainly trade a lot higher. And then even if this growth starts to slow down, they are still benefiting from high levels of cash flow, and therefore I think their dividend yield on cost will certainly increase over the longer term, meaning that if you haven't got a great growth investment, at least you've got a very strong dividend growth stock in your portfolio. In fact, I would go as far to say that this stock could appeal to an investor of any age and any background. This is because of their reliable dividend history. Whilst yes, they did cut it in the last year, they have since grown it beyond the amount they had cut to, but then they've also paid back the furlough scheme administered by the government because they didn't need it and they had that extra cash available. Meaning this stock could be a great balance between the growth potential and the future of their intellectual property and where that can take them, but also between a strong dividend payer with quarterly payments that can increase cash flow in your portfolio. As I said, it's far from a value stock. They're trading at a significant premium, around a 35 times price to earnings ratio compared to both the industry and market, but I'm happy to pay a premium for a quality company. In the last 5 years, they've returned shareholders with 2,536.5% with dividends reinvested. And as of this video, I hold 52 shares of Games Workshop, and I'm very likely to continue buying, and it may become a point where this becomes the biggest position in my portfolio. With a market capitalization of £3.4 billion, there's definitely room for them to grow a significant amount in the next 10 to 15 years, and I remain long on them. At the moment, they take up 31% of my portfolio, and I think over time this will certainly go down, but that will only be as I have more diversified investments. But at this current stage, I'm trying to increase my wealth rapidly as I can take on more risk as I am younger, and therefore I have higher exposure to certain individual stocks to therefore bolster my wealth, and then over the long term, once I have built that wealth, I will look to preserve it and diversify a lot more. If you're interested in my monthly dividend pay rise portfolio using the Trading 212 app and how to build one, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a great day.